If any house is not let out for rent purpose or for lease, then it is not taxable, it is exempt. Any arrears, okay, you let it out the property last year, but last year for 2 months he didn't pay the rent, but he paid last 2 months rent in this year, then it is also taxable. So to find out the gross annual value, these 4 things are most important. That is rent payable, that is actual rent, municipal value, fair rent and standard rent. Hello everyone, I am Arun Kumar, lecturer in Department of Commerce and Management, Vidhyaashram First Grade College, the Temple of Excellence, MYSURU. Dear students, welcome to this new session number 1 on unit number 4, that is income from house property under the subject Income Tax Law and Practice 1, which is there for 5th SEM BCom students who are studying under University of Mysuru. Yes, dear students, for this many days, for this many sessions, we discussed and we learned about what is income tax and what is residential status, how to compute gross total income, and we also discussed about the different terminologies and how to compute income from salary, and about this all concept we discussed. Today in this session we will be discussing about income from house property. So before getting to solve the problem about income from house property, first we have to understand few basic concepts with respect to income from house property. So what is this income from house property? When we are supposed to compute the income from house property and who are all eligible or who are supposed to pay this tax and who are supposed to file this income tax return with respect to income from house property. If you are owning 2 to 3 houses and if you are the owner of those 3 houses, what you will do? You will stay in one house and you let out another 2 property for rent purpose, right? And you will be receiving 10,000 per month from each flat, and if you are having extra 2 flats, you will be receiving 20,000 rupees from extra 2 flats which you let out. So that 20,000 rupees per month is your profit, right? So for 1 year, how much you will be earning? You will be earning more than 2,40,000 rupees. So the 2,40,000 is income, and on that income you are supposed to pay tax to the government. So for calculation of this income, you are supposed to follow the procedure under income from house property. So here income from house property is with respect to if any person is earning rent by letting out the property for rent, those people comes under income from house property head, and they are supposed to compute their income for the income tax purpose under the head of income from house property. So income from house property, it deals with under section 24, and here determination of annual value. Yes, income from house property is determined under section 24, and the determination of annual value, we will done it or we are going to do it under section 23. Let out property, it comes under section 23 subsection 1, and property occupied by the owner, it comes under section 23 subsection 2, and property owned by the co-owner, section 26. Interest on housing loan, it comes under section 80 EE, and unrealized rent allowed, it comes under section 25 A. Unrealized rent received, it comes under section 25 AA, and the taxation of arrears of rent, it comes under section 25 B. So this particular chapter, income from house property, it deals with many aspects, whether it is like the occupancy of the house or let out to some tenant or unrealized rent recovered or rent received, whatever. For each and every aspect we have the sections. So those sections are going to determine about how to compute the value and how to deal with a particular aspect. So this many sections are there under income from house property to know about how to compute and how to know the value of the particular house. And exempted items are also there. Few items are exempted from income from house property. Even though you are earning rent, you need not to pay tax to the government. Those houses are exempt from tax. So which are those? The first one is the house was not let out. That means you have 2 houses, you are staying in one house and one house is still vacant. You have not letted out it to anybody else. Still it is vacant. So if it is vacant, then need not to pay tax to the government or need not to compute income of that particular house. So the house was not let out. If any house is not let out for rent purpose or for lease, then it is not taxable, it is exempt. Next, income from one self-occupied house. Yes, if you are owning 2 to 3 houses and if you are staying in one house, the house where you are staying, it is exempt from income tax. You need not to calculate the taxability of that particular house. So if you are occupied for your living purpose, then it is exempted from tax. You need not to calculate the income of that particular house. Next, registered trade union. Yes, if any registered trade union is going to let out the property, then they are also not supposed to compute the income from house property. It is also exempt from tax. And the annual value of any one palace in the occupants of an ex-Indian ruler. Yes, the annual value of any one palace in the occupation of an ex-Indian ruler. So if there is any ex-Indian ruler, if the ruler is alive, and if we having 2 to 3 palace, in that one palace will be exempt from tax. It is not taxable. Next, income from property owned by scientific research association. Yes, if any scientific research association, if they are having any house property and if they let out that house property for rent purpose, that is not taxable, that is exempt from tax. Next, income from property owned by local authority. Yes, if any local authority is owning the property and if they are letting out the property for rent purpose, whatever the rent received on that property is not taxable, it is exempted from tax. Next, income from property owned by charitable trust. Again, if any charitable trust is owning the property and if they are letting out the property for rent purpose, it is also not taxable. And income from property owned by political party. Yes, if any political party is owning the property and if they are letting out the property, then if they are earning any income on that property, it is also not taxable. So in these many scenarios, in these many cases, even though they are earning the rent or even though they are earning the income from that property or from that building, it is not taxable. It is exempted under the income from house property income. Next thing, incomes taxable under house property head. Yes, in the previous slide, we got to know which are all the items are exempted from house property. Here you get to know which are the items are taxable under income from house property. In that, the first one is any let out property. If you are letting out the property and if you are earning the rent or if you are earning the income, then it is taxable under income from house property. Next one, let out of commercial building, shops and complex. Yes, if you let out any residential property, it is also taxable. And if you let out any commercial building, shops or complex, that is also taxable. Next, income from farmhouse or agriculture land, but which is not used for agriculture purpose. So you have an agriculture land, but you're not using that for agricultural purpose. You let out for some commercial purpose, for business purpose. So at that point of time, it is taxable. If it is used for agricultural purpose, it is not taxable, it is exempt. If it is not used for agricultural purpose, if it is used for commercial purpose, then it is taxable. Next, any arrears received but not taxed under section 23 received in a subsequent year. Yes, any arrears. Okay, you let it out the property last year, but last year for 2 months it didn't pay the rent, but he paid last 2 months rent in this year, then it is also taxable. In these many cases, it is taxable under the head of income from house property. And moving further, gross annual value. So what is this gross annual value and how to compute this gross annual value? So if you get the gross annual value, by using that you can find out the annual value and taxable income under house property. So without knowing the gross annual value, you can't find it. The gross annual value is also called GAV, gross annual value. It is also called GAV. So to find out the gross annual value, these 4 things are most important. That is rent payable, that is actual rent, municipal value, fair rent and standard rent. So in short, what we will call? We will call municipal value, fair rent, standard rent and actual rent. Okay, fair rent, municipal value, standard rent and actual rent. By using these 4 items, elements or the components, we are going to find out the gross annual value of a particular let out property. So how to find out? See, first thing, you are supposed to compare. You are supposed to compare the municipal value and fair rent. You are supposed to compare municipal value and fair rent. In these two, which whichever is high. Okay, in these two, whichever is high. For example, say here you have 100 rupees, here you have 200 rupees. Which is the highest amount you have? 200. So you will take 200. Okay. Next, what you will do? You compare this 200 rupees with standard rent. You compare this 200 with standard rent. So what is the standard rent you are earning? Let us say you are earning 150 rupees. Standard rent you are earning 150 rupees. Now compare this 200 with standard rent, whichever is low. So which is the least amount now? Lowest amount? 150. Right. Now compare this 150 with the actual rent. Compare 150 with the actual rent. So what is the actual rent now here? Let us say the actual rent is 250. In these two, whichever is high. So which is the higher amount? It is 250. This 250 is called gross annual value. I hope all of you understood. Right. So to compute the gross annual value, we have four elements, that is actual rent, municipal value, fair value and standard rent. So first what we will do in first step, in step 1 we compare municipal value and fair rent, whichever is high. Whatever the amount you get in step 1, you compare this with the standard rent. Okay, whichever is low. The lowest is 150. Then you compare the lower value with the actual rent. Okay, in these two, whichever is high, you got 250. That is called gross annual value. So this is how you are supposed to find out the gross annual value under income from house property. If you know how to find this, then it will be very easy to solve the problems. So now moving further, municipal taxes. Yes, municipal taxes, if it is paid by the owner, what is the treatment? If it is paid by the tenant, what is the treatment? That you must know, then it will be easy to solve the problems. So the taxes including service taxes, fire tax, education tax or water tax, etc. levied by any municipality or local authority in respect of any house property. Yes, if they are charging any kind of tax, okay, if the local authority or the municipal authority, if they are charging any kind of tax, then you are liable to pay the tax to the government. So who is liable to pay the tax? Yes, obviously the owner of the property is liable to pay the tax, not the tenant. If tenant pays, we ignore, we will not consider that value to compute the income from house property. The tax should be paid by the owner of the property. Next, we will deduct municipal tax paid by the owner, not by the tenant. Yes, as I said, if any tax is imposed by the municipal corporation or municipal authority, then we will be paying the tax, and the tax should be paid by the owner of the property, not by the tenant. If owner pays, then we will take it as a deduction. We will take it as a deduction from the total income. If it is paid by the tenant, then we will not be considering for deduction purpose. This is about the municipal tax and how we treat the municipal tax in income from house property. Next, unrealized rent. So what is this unrealized rent? So unrealized rent is a rent not realized. That means the unrealized rent is nothing but is supposed to pay the rent, but the rent is not paid for that particular months. Okay. Next, house is let out and used, but still rent is not given by the tenant. That is called unrealized rent. So he was living in the particular let out property, but the tenant failed to pay the rent. He is there in the property, but he didn't pay the rent. That is called unrealized rent. Next, it is rent yet to be receivable. Yes, so it is rent yet to be receivable. That means the rent is not yet received. The particular tenant is staying in the house, but yet is not paid the rent. That will be called as the unrealized rent. And unrealized rent is nothing but again the rent yet to be received. Next, it is to be deducted in the actual rent or from the gross annual value. Yes, suppose he is supposed to pay you rent of 10,000 rupees every month. So then what will be the value for 12 months? It will be 1,20,000, right? 1,20,000. But what happened? He failed to pay the 2 months rent in that particular year. Okay, he fails to pay the 2 months rent in the particular year. Then what will be the 2 months rent? So 10,000 into 2, yes, obviously it is 20,000. So you're supposed to deduct this 20,000 from 1,20,000. Then what is the balance? This 1 lakh is the balance. 1 lakh is called actual rent. That means You are supposed to collect 1,20,000 rupees for a particular year, but the tenant failed to pay 2 months rent of rupees 20,000 and you are deducting the 20, and what's your income for that year? It is 1 lakh rupees. That will be called as the actual rent. Next, moving further, format. Yes, this format is very much important for computation of income from house property. If you know the format, easily we can solve it. And the format is also very easy. Once if you understand this, easily you can score 15 marks in your main exam. This is the one of the easiest topic what you have in this particular subject. So format, it is very simple. You are supposed to make 3 columns, particulars, amount. You are supposed to make 3 columns, particulars, amount. Okay. Next, gross annual value. Gross annual value. Yes. First, you are supposed to take the gross annual value in the inner column. I have already told you how to find out the gross annual value. They will be giving you 4 items, that is fair rent, municipal value, standard rent, actual rent. And by doing 3 steps, high, low, high, you will get the gross annual value and you will post that gross annual value here. Okay, you will post it here. You will take the gross annual value in the inner column, less municipal tax paid by the owner. So from gross annual value, you are going to deduct the municipal tax paid by the owner. If the owner is paid the municipal tax, then it is deductible from the gross annual value. If it is paid by the tenant, then we will not be considered it for a deduction. So gross annual value less municipal tax, you will get the balance, right? This balance is called annual value. Okay. So from annual value, less deduction under section 24. In that, the first point is 30% of annual value. So whatever the value you get here, on this value, you are supposed to find out 30%. For example, your gross annual value is like say 20,000. Okay, it is 20,000. You paid 5,000 rupees of municipal tax. As a owner, you paid 5,000. What is the balance? Yes, it is 15,000 is the balance. Correct. This 15 is called what? Gross annual value. Now, less deduction under section 24. In that, the first thing is 30% of annual value. So what is the annual value we have? The annual value we have is 15,000 into 30%. So how much you will get? Yes, obviously 4,500. Correct. So interest on loan is given. Yes, if any loan is taken by the owner of the property and if he is paying interest on that loan, then it is also deductible. Whatever the interest is paying, it is also deductible. Let us say he is paying the interest of rupees 500. Okay, only these two are deductible. So deduct these two, that is 4,500 and 500 from 15,000. You will get the balance of 10,000. Okay, you'll get the balance of 10,000. For that 10,000, if any unrealized rent is recovered, that means last year you were supposed to pay the rent, he didn't pay the rent. Okay, in the last year, but in this year he paid that rent, he paid the arrears. So that is supposed to be added here. So let us say you received 2,000 rupees of unrealized rent of the previous year. Now what is the total? The total you will get is 12,000 rupees, right? You take the 12,000 rupees to the outer column. This 12,000 is going to be called as income from house property. So this is the format what you are supposed to follow to compute the income from a house property. Okay. If they give 4 houses, you are supposed to do it this 4 times. That's it. It's very easy. The thing is, you should have to know how to compute the gross annual value and what is the deductions we will be giving to them under section 24. Fine. I hope all of you understood this particular format. We will move on and we'll solve few problems with respect to this concept. So we go with the first problem. Problem number 1. From the following information, compute gross annual value. Okay. So municipal value is given, fair rent is given, standard rent is given, actual rent is given. Yes, in this the values is also given. They are given for 2 houses, house 1 and house 2. Okay. How we are supposed to solve it and what is the format? Yes, I have told you we are supposed to do it in 3 steps. So house 1 we solve first. House 1. First we will take municipal value and fair rent. So what is the municipal value and fair rent? We have house 1. Municipal value is 15 and fair rent is 18. So municipal value 15 and 18. So in these two, whichever is I, which is the highest amount? Yes, obviously 18,000. Okay, you compare this 18,000 with standard rent. So what is the standard rent we have? It is 20,000. right? So compare 20,000 with 18,000, whichever is low. So how much you will get the lowest value? Yes, it is 20,000. Compare this 20,000 with actual rent of 16,000. So 16,000 you take. In these two, whichever is high, which is the highest value in these two? Yes, it is 20,000, right? 20,000. This 20 is called gross annual value of house 1. Next, same to the house 2. Okay, house 2. So we will take the municipal value and fair rent. So what is the municipal value house 2? 30 and fair rent 32. So 30,000 and 32,000, whichever is high, which is the highest amount, 32. So take this 32 and compare with the standard rent. So what is the standard rent? It is 40,000, right? 40,000. So whichever is low, which is the lowest amount? Yes, 32,000. Compare this 32,000 with actual rent. 32,000 with actual rent. What is the actual rent given in the problem? It is 36. So write 36 here. Okay. Now compare in these two, 32 and 36, whichever is high, which is the highest amount? Yes, it is rupees 36,000. This 36 is called gross annual value of house 2. So house 1 gross annual value 20 and house 2 gross annual value is 36. It's very easy. In this way, you're supposed to find out the gross annual value. We solve one more problem with respect to the same concept, that is gross annual value. So municipal value, fair rent, standard rent, actual rent is given, and house 1, house 2 is given. So we go with the format. So municipal value and fair rent. So what is the municipal value and fair rent? 90,000 and 1 lakh. So 90,000 and 1 lakh. 90,000 and 1 lakh, whichever is high, which is the highest amount? Yes, it is 1 lakh. So compare this 1 lakh with standard rent. With standard rent. What is the standard rent? Standard rent is not given. Then directly you take this 1 lakh rupees and you compare it with actual rent. So what is the actual rent? It is 1 lakh 10,000. In these two, whichever is high. Okay. If standard rent is given, you compare with the standard rent, whichever is low. If standard rent is not given, just compare this 1 lakh with the actual rent, and whichever is high, which is the highest amount, 1 lakh 10,000. This will be your gross annual value of house 1. Next, house 2. We solve for house 2. So what is the municipal value and fair rent for house 2? Yes, municipal value is 1 lakh 20. Fair rent is not given. Okay, fair rent is not given, which is the highest amount. Obviously, it's 1 lakh 20 only, right? So 1 lakh 20 compare with standard rent. What is the standard rent? It is 1 lakh 50,000. So compare with 1 lakh 50,000, whichever is low. So 1 lakh 20 you will get, right? So 1 lakh 20. And compare this 1 lakh 20 with actual rent. Okay, if you compare with actual rent of rupees 1 lakh 40, so whichever is high, so which is the highest amount? Yes, it is rupees 1 lakh 40,000. So this 1 lakh 40 will be called as gross annual value of house 2. So this is how we are supposed to find out the gross annual value of a particular house. So if you find out this gross annual value, then it will be easy to find the income from house property of any house. So with this, I'm going to wind up this session. I'll come up with few more new topics with respect to this session. Until then, thank you all. Have a nice day. Namaste.